Australia just detonated a financial earthquake. Fortescue, the iron ore giant, walked away from Wall Street and locked in nearly $2 billion in Chinese yuan, borrowing at rates usually reserved for governments. Weeks later, Australia's Treasury issued its first yuan bond, and the Reserve Bank shifted a quarter of its reserves into Beijing's currency. The IMF says no advanced economy has ever moved this fast. If Washington's closest ally is already bankrolling its future through China, you have to wonder how long before the dollar's grip begins to snap. Fortescue's deal, announced in early August 2025, was a 14.2 billion yuan syndicated loan, about $1.98 billion US dollars, arranged by the Bank of China and ICBC. Reuters reported on August 7th that no Australian corporation had ever borrowed in Chinese currency at this scale, and Fortescue achieved it at rates almost identical to Canberra's own borrowing costs. Australia crossed a line it had avoided for decades. Fortescue, one of the world's largest iron ore producers, announced in early August 2025 that it secured a 14.2 billion yuan syndicated loan, about $1.98 billion US dollars, at a fixed rate of 3.8%, arranged by the Bank of China and Industrial and Commercial Bank of China. According to Reuters on August 7th, this was the first time an Australian corporation financed itself in Chinese currency on such a scale, and it was done at a cost nearly identical to what Canberra itself pays to borrow. That detail is striking. Bloomberg reported that Australian government 5-year bonds were yielding 3.67% at the close of markets on August 22nd, only marginally below Fortescue's 3.8% deal with Chinese lenders. A sovereign can tax and print its way out of repayment trouble. A private mining company cannot. Yet Chinese banks offered Fortescue almost sovereign-level terms. The company, in its own press release, confirmed that this loan achieved its lowest ever cost of debt. This event did not occur in isolation. In February 2025, during its quarterly earnings call, Fortescue executives admitted concerns about the viability of its $550 million hydrogen project in Arizona under shifting U.S. regulatory frameworks. By July, the project was shuttered, with the company booking a $150 million impairment charge. The Wall Street Journal described this as a signal of investor uncertainty in U.S. clean energy policy. Fortescue abandoned its American experiment and turned decisively toward China. China already purchases more than 80% of Fortescue's iron ore exports, according to Australia's Department of Industry data released in June 2025. That dependence creates leverage. By financing expansion in Yuan, Fortescue aligns repayment obligations with revenue flows, nearly eliminating foreign exchange risk. The Financial Times noted that the company immediately linked this loan to its plans for a green steel industry, sourcing $400 million in electric machinery from Chinese firm XCMG. This suggests that Beijing is not only Australia's buyer, but increasingly its banker and supplier. The implications extend into Australia's financial system. Reuters reported in August 2025 that syndicated yuan lending in Sydney is now permitted under Australian banking law, with both Chinese and Australian branches participating. That regulatory change was quiet, but it allowed this transaction to happen. If more companies follow, the shift could undermine the primacy of US dollar clearing in Australia's corporate debt market. Numbers already show momentum. The Australian Bureau of Statistics released trade data on September 1, 2025, revealing that 14% of Australia's exports to China were invoiced in yuan, up from 3% the year prior. The IMF, in its September 2nd consultation report, calculated that if this trend persists, Australia could reduce its dollar reserve requirements by the equivalent of $20 billion annually. That would alter the Reserve Bank's composition of foreign exchange holdings and reduce transaction costs. The banking infrastructure is adjusting. ANZ, in a June 2025 statement, confirmed it had launched yuan clearing services for corporate clients. The People's Bank of China, according to the Wall Street Journal on July 20th, announced preferential cross-border clearing fees, 0.05% for yuan compared to 0.25% for dollars, for a 3-year period. This is a subsidy designed to accelerate adoption, and Australian companies appear to be responding. Executives are frank about the rationale. A senior mining official told the Financial Times on September 2nd that shifting procurement contracts into yuan hedges against volatility and reduces reliance on U.S. lenders. When paired with Fortescue's near-sovereign borrowing terms, the pattern becomes clearer. Australia's largest private sector players are testing whether China can provide not just demand, but capital, equipment, and financial infrastructure. The Reserve Bank of Australia's quarterly bulletin on September 1st confirmed that yuan now accounts for 25% of its foreign reserves, up from just 5% in mid-2024. Central banks rarely make such a rapid shift in reserve composition. The IMF reported on September 2nd that across the Asia-Pacific region, the average increase in yuan holdings was 40% year-on-year. Australia is moving even faster. This raises questions. If a US ally increases Yuan reserves five-fold in under 2 years, what does that mean for its access to Federal Reserve swap lines during crises? The Lowy Institute, in a September 2nd policy paper, warned that reserve diversification could risk partial disconnection from US-backed liquidity networks. Treasury officials counter that diversification is insurance, not alignment, but the balance is delicate. Diplomatic pressure is already visible. The Financial Times reported on September 3rd that a leaked cable from Australia's embassy in Washington described US authorities as monitoring UN bond activity in Sydney with growing concern. This language suggests that de-dollarization is not viewed as benign diversification in Washington, but as a potential strategic shift. At the same time, domestic institutions are embedding yuan into their frameworks. The Australian Prudential Regulation Authority released a consultation paper on September 3rd evaluating guidelines for local banks to hold yuan clearing accounts. The Future Fund, Australia's sovereign wealth fund, announced it will allow up to 10% of its assets to be allocated in yuan starting next fiscal year. Australia's largest superannuation fund launched a yuan-denominated infrastructure debt vehicle on August 31st, targeting projects such as China's Beijing green hydrogen plant. Trade finance reflects the acceleration. The Australian Foreign Investment Review Board confirmed on September 1st that 80% of Chinese direct investment into Australia during the first half of 2025 was settled in yuan, with inflows rising 12% year-on-year. Bloomberg's FX data showed that AUD-CNY turnover doubled in 3 months, hitting $2 billion daily in late August. Reduced volatility in AUD-USD trading, down 15% over the same quarter, is now attributed by strategists to greater use of yuan settlements. The fiscal impact is material. Federal budget papers released on September 1st estimated that yuan-based funding saved Canberra $200 million in interest payments during 2025. That figure is not theoretical. It directly affects taxpayers and borrowing costs. The corporate momentum continues. A private Australian investment firm disclosed plans on September 3rd to issue its first yuan-denominated green bond in early 2026, targeting investors in both Sydney and Hong Kong. This extends de-dollarization beyond trade and sovereign finance into the private capital markets. By late August, the People's Bank of China reported that cross-border trade settled in yuan with Australia exceeded $50 billion in the first 7 months of 2025, already surpassing the full-year total of 2022. The scale of this shift cannot be understated. Australia's de-dollarization is not an abstract policy debate. It is unfolding in corporate boardrooms, central bank portfolios, and trade ledgers. Fortescue's loan is one piece of a larger pattern in which Australian institutions are recalibrating their financial architecture toward China. Whether this is diversification or dependency remains contested, but the evidence is measurable. In early September 2025, Bloomberg revealed that the Port of Newcastle, Australia's largest coal export hub, processed its first yuan-settled shipment bound for Guangdong, valued at $820 million Australian dollars. This was confirmed by port officials, who described it as administratively smoother than dollar invoicing. Days later, Reuters reported that BHP, the world's largest mining company, signed a memorandum of understanding with the Bank of China to explore yuan financing for future copper projects, noting that copper demand in China is forecast to rise 4% in 2026. The financial sector is shifting in parallel. The Australian Stock Exchange confirmed it will list yuan-denominated bonds beginning in October 2025. Opening the door for corporate issuers to tap Chinese investors directly. This move follows data from the Financial Times showing that yuan bond issuance globally jumped 34% year-on-year in the first half of 2025, with Australia singled out as a new frontier market. Policy adjustments are following fast. On September 4th, the Australian Treasury disclosed in its mid-year update that yuan-denominated borrowing will be incorporated into the country's core sovereign funding strategy. This is the first time non-dollar debt has been elevated to that status. Meanwhile, the IMF warned in its September 2025 regional outlook that if Australia maintains this trajectory, its dollar exposure in reserves could fall below 40% within 2 years, a level that would make it one of the most diversified developed economies in currency terms. All of this raises a single, unresolved question. If Australia embeds yuan this deeply into its financial system, will the dollar ever regain the ground it has lost? So the story closes not with a tidy conclusion, but with a number that reframes everything. More than $50 billion in Australian trade with China settled in yuan in just 7 months, eclipsing 2 years of prior totals. If that pace continues, how long before the US dollar ceases to be Australia's default currency for global business? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.